Section 18 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 5, Subprime Lenders in Turmoil, Adverse Market Conditions. Among non-bank mortgage originators, the late 1990s were a turning point. During the market disruption caused by the Russian debt crisis and the long-term capital management collapse, the market saw a flight to quality. That is, a steep fall in demand among investors for risky assets, including subprime securitizations. The rate of subprime mortgage securitization dropped from 55.1% in 1998 to 37.4% in 1999. Meanwhile, subprime originators saw the interest rate at which they could borrow in credit markets skyrocket. They were caught in a squeeze. Borrowing costs increased at the very moment that their revenue stream dried up. And some were caught holding tranches of subprime securities that turned out to be worth far less than the value they had been assigned. Mortgage lenders that depended on liquidity and short-term funding had immediate problems. For example, Southern Pacific Funding, or SFC, an Oregon-based subprime lender that securitized its loans, reported relatively positive second quarter results in August 1998. Then in September, SFC notified investors about recent adverse market conditions in the securities market and expressed concern about the continued viability of securitization in the foreseeable future. A week later, SFC filed for bankruptcy protection. Several other non-bank subprime lenders that were also dependent on short-term financing from the capital markets also filed for bankruptcy in 1998 and 1999. In the 2 years following the Russian default crisis, 8 of the top 10 subprime lenders declared bankruptcy, ceased operations, or sold out to stronger firms. When these firms were sold, their buyers would frequently absorb large losses. First Union, a large regional bank headquartered in North Carolina, incurred charges of almost $1.7 billion after it bought the money store. First Union eventually shut down or sold off most of the money store's operations. Conseco, a leading insurance company, purchased Greentree Financial, another subprime lender. Disruptions in the securitization markets, as well as unexpected mortgage defaults, eventually drove Conseco into bankruptcy in December 2002. At the time, this was the third largest bankruptcy in U.S. history, after WorldCom and Enron. Accounting misrepresentations would also bring down subprime lenders. Keystone, a small national bank in West Virginia that made and securitized subprime mortgage loans, failed in 1999. In the securitization process, as was common practice in the 1990s, Keystone retained the riskiest first lost residual tranches for its own account. These holdings far exceeded the bank's capital, but Keystone assigned them grossly inflated values. The OCC closed the bank in December 1999 after discovering fraud committed by the bank management, as executives had overstated the value of the residual tranches and other bank assets. Perhaps the most significant failure occurred at Superior Bank, one of the most aggressive subprime mortgage lenders. Like Keystone, it too failed after having kept and overvalued the first loss tranches on its balance sheet. Many of the lenders that survived or were bought in the 1990s reemerged in other forms. Long Beach was the ancestor of AmeriQuest and Long Beach Mortgage, which was in turn purchased by Washington Mutual, two of the more aggressive lenders during the first decade of the new century. Associates First was sold to Citigroup, and Household bought Beneficial Mortgage, before it was itself acquired by HSBC in 2003. With the subprime market disrupted, subprime originations totaled $100 billion in 2000, down from $135 billion 2 years earlier. Over the next few years, however, subprime lending and securitization would more than rebound. End of section 18.